So the European Union had this massive, ambitious plan to force corporations to be transparent about sustainability. Seriously, it was a plan designed to change the world. But something went really, really wrong. Today, we're going to break down exactly what happened to Europe's green rules and what it all means for the future.
That's the powerful opening line from a recent strategic report. You'd think 2025 would be this landmark year, right? A huge win for the planet. Instead, it became the year the EU's big consensus on its own Green Deal just shattered. It smashed head-on into geopolitical and economic reality.
So the big question is, how on earth did we get here? To really get a grip on what's happening, we've got to go back and look at what one report calls a legislative car crash. That's the moment the whole original vision was just completely wrecked. Okay, so this legislative crash of 2025, it really boils down to two huge blows that fundamentally changed the EU's Corporate Sustainability Reporting Directive. The CSRD. The first punch came, and get this, it was disguised as simplification. The European Commission was under incredible pressure to boost competitiveness, so they rolled out these things called the omnibus packages. The goal, they said, was to cut red tape, but the real effect, it systematically tore down the directive's power. And here's exactly how they did it. They took the definition of a large undertaking, a company that had to follow the rules, and they blew it up. The employee threshold wasn't just tweaked, it was quadrupled. Overnight, it jumped from 250 employees, boom, all the way up to 1,000. And you might be thinking, okay, so what? Well, the impact of that one little bureaucratic change was absolutely massive. It effectively wiped an estimated 80% of the companies that were originally targeted right off the list. It just gutted the very heart of the regulation. But the omnibus packages didn't stop there. Oh no. They also brought in something called a value chain cap. Basically, it's a legal shield that stops big companies from forcing their smaller suppliers to hand over detailed sustainability data. This created a gigantic blind spot right in the middle of the supply chain, making real transparency legally impossible to enforce.
And then came the second blow, the Stop the Clock Directive. As you can see right here, key reporting deadlines for most companies were just kicked down the road by 2 full years. This sent a crystal clear signal to the market. Deadlines don't really matter. It was basically a gift to the companies that had dragged their feet and a slap in the face to all the ones who had actually invested early to get ready.
So, okay, the original dream is in tatters. The question now is, what happens next? Well, the source material we're looking at lays out 4 possible and competing futures for sustainability reporting as we head towards 2030. First up, we've got the optimistic scenario. Let's call it the Brussels dream. In this future, the technical experts in the EU manage to steady the ship. They line up their rules with global standards so well that the EU model becomes the default for any big multinational, just because it's the most complete one out there.
And what's really interesting is that there's still evidence this could happen. We've seen some surprisingly good teamwork between the EU and global standard setters. And here's the kicker. China has also adopted a similar double materiality idea. That means companies have to report on how sustainability affects their bottom line and how their business affects the planet. This could create a huge Eurasian standard that leaves the US model out in the cold.
But there's a fatal flaw, a huge one. Remember that value chain cap we just talked about? Well, it means that even these perfect, globally aligned reports are going to be built on a foundation of sand. They'll be based on estimates and industry averages, not real data from suppliers. It's like a beautiful movie set, a Potemkin village, with nothing behind the facade.
And this leads to a really chilling question for any executive or board member out there. If the auditors are the ones signing off on reports based on fuzzy estimates, has all of the risk just been quietly moved from the polluters in the supply chain to the giant accounting firms themselves?
Okay, our second possible future is basically born from a backlash against these new, weaker rules. In this scenario, you've got the high-ambition countries, think Sweden, Finland, France, and they decide to gold-plate their own national laws. This creates a messy, two-speed Europe when it comes to sustainability. And the evidence for this is pretty solid. We've already seen major Finnish companies literally begging for more regulation to protect the big investments they've already made. And countries like Sweden and France, well, they have a long history of going above and beyond the EU minimums to keep their edge in the green economy.
But the fatal flaw here is a really painful paradox. The more an honest, gold-plated company reveals about its climate risks, the riskier it looks to investors, especially when compared to a competitor in another country that's legally allowed to hide that exact same information. It creates what's called an honesty penalty, where the money actually flows to the less transparent companies.
So the crucial question becomes a massive gamble, right? Can these leading nations successfully sell their higher standards as a premium quality seal? Or will they just end up punishing their own industries by piling on costs that their neighbors have already thrown out? Our third future is where things get a little sci-fi and suggests that all this political fighting in Brussels might soon be, well, totally irrelevant. In this scenario, technology just leapfrogs regulation. AI and blockchain automate the entire reporting process, and the cost of doing all this just plummets to almost zero. The signals for this are already flashing. We're seeing the rise of AI agents that are literally designed to draft these reports for you automatically. Blockchain is creating audit trails that can't be tampered with. And get this, digital twins, these virtual copies of entire factories, are starting to stream live environmental data. The whole idea of an annual report just becomes obsolete. But here's the terrifying flaw: the risk of automated greenwashing. You could have boards of directors signing off on sustainability reports generated by AI systems they don't understand at all. This could create a huge systemic risk where the AI isn't optimizing for truth. It's just optimizing for a good score. And that brings us to our fourth and final scenario. And folks, this is the bleak one: a total political collapse. The Green Deal gets officially tossed out and replaced by an industrial deal that cares about one thing and one thing only: competitiveness. Sustainability reporting becomes optional, and the EU basically throws in the towel. The evidence for this dark scenario is disturbingly strong. You've got this coordinated legal assault coming from the US, with states threatening to sue American companies if they dare to comply with EU rules. Meanwhile, back in Brussels, the political will has just evaporated. And the big audit firms, they're already laying off their ESG consultants. But the flaw in this great rollback is simple. Climate risk is real, whether you report it or not. By letting companies just hide how exposed they are to climate change, the EU would essentially be creating a museum of zombie companies. Businesses that look perfectly healthy on paper, but are secretly destined to fail the next time a climate shock hits. And this poses a fundamental, almost existential question for the European Union. If it just abandons its own standards, is it basically admitting that its entire social model, this idea of trying to price in environmental costs, just can't survive in a ruthless globalized world? So with these four wildly different futures on the table, if you just take a step back for a second and follow the money, a very, very clear pattern starts to emerge about who really stands to win, no matter which path we end up on. Just take a look at this. It's fascinating. Across almost every single possible future, the main financial winners aren't the companies getting more sustainable, and it's not the planet. The winners are the intermediaries, the Big Four auditors, the national law firms, the US tech giants, and the litigation industry. They are the ones who thrive on all the complexity, the division, and the conflict. And this brings us to the report's powerful and, pretty cynical final word. What started out as this ambitious tool to transform capitalism and save the planet might, by 2030, have become little more than a full employment program for auditors and software salespeople. And that leaves us with one last really provocative thought to chew on. If reporting becomes this fully automated thing run by US tech platforms, has Brussels accidentally outsourced the governance of its own flagship Green Deal? It might just be that the real revolution isn't coming from the regulators in Europe, but from the coders in California.